Hey, hi, good afternoon. Good evening, guys. I'm Ziang from FSM1. I'm a senior macro analyst with IFAS. And today I'd like to talk about, share some of my views of the market, especially after the recent, if anyone of you have been following on the market, we have seen that there's quite a bit of volatility. Market, I think just the last few trading session in the US have been going up by 10% swings. And I think what does it entail, and what should investors position themselves in such an environment? So without further ado, let's look through this. Let me go through the slides. Right, these are some basic disclaimers that some of the content are actually for information. Yeah. So I think right now the biggest thing that's moving market has to do with the coronavirus, the COVID-19 outbreak that appeared as more or less a black swan event. This, which originated from Wuhan, was a kind of a strain of a coronavirus that was not previously identified in human time. As a result, as a species, we do not have the immunity towards it, and it's actually with some basic information is that it's actually within the same family as that of SARS and that of MERS. Although it originated from Wuhan, that in central China, it actually swiftly spread across the whole of China, and then eventually right now is all across the world. But on a more positive note, you can see that the COVID virus situation is sort of reasonably contained within China, and the rate of new infections have actually kind of peaked then. If you look at the charts, you can see that the whole thing kind of spiked up in terms of worldwide from 18 Feb onwards, and that had quite a bit of implication on market from 19 Feb from on. So what investors initially thought was more or less a virus outbreak that's going to be largely isolated within China as well as Asia has started to spread rapidly across the globe. And the fears of an uncontrolled global contagion was amplified as cases started to spring up in different parts of the world, especially at South Korea, Italy, Iran, at a kind of breakneck pace. Unlike China, where most of the outbreak has been reasonably contained, many of these countries, right, are still in the early stages of the COVID-19 outbreak. And you can see from 18 Feb onwards, the cases outside of China has seen kind of an exponential rate of increase. And it's quite troubling because when it comes to developing countries with inadequate healthcare structure, there's fears that this will actually spring up very, very quickly and spread like wildfire. And I think this fear of an uncontrolled global contagion was sort of confirmed by WHO, the World Health Organization, when it was quite reluctant to declare a COVID virus a pandemic. Initially, just stick with just an emergency, a global emergency. But eventually, I think 2 weeks, about last week, it actually declared that it is a pandemic right now. And that created that the fear of the global contagion sort of confirmed by the World Authority on Health. And it's also at the same time, just last week, it's also complicated by the fact that the oil prices suddenly crashed. What was planned to actually keep oil prices up and to leave up oil prices instead take a turn for the worse and turn into a full-blown price war. And you can see the three main indices in the US actually fell more than 20% from their all-time high, putting them back into a sort of a bear market that we have not seen for more than 10 years. In fact, because of that, investors also start to embrace the risk-off sentiment. They don't know what is going on, and more confusion, especially as more media coverage talking about this COVID virus being spread quickly across the world. And the risk-free rate caused the entire US Treasury curve to fell briefly below the 1% point, which is actually the first time ever in history as investors swing towards an extreme risk-off sentiment. Right. So, and what was confirmed that things are actually going to look bad was what was actually intended to be something, a well-intended move, which is to cut interest rate, sort of to help make financing or sort of boost confidence of investors as well as businesses when it comes to financing them at this point of time. But was actually taken quite negatively by investors because of the drastic, firstly, it was quite odd. I think when it first initiated the 50 basis point of rate cut in the early of March, and then of course, just last weekend, they cut another 1% down all the way to zero right now when it comes to US interest rate. It was actually kind of odd because the timing is in between the FOMC meeting, which is kind of a meeting for them to discuss their interest rate policy. And that also the magnitude of which usually their cuts comes in series of 25 basis points each. But this time they cut by 50 basis points as well as 100 basis points just straight. And that was before a meeting. So it signaled to a lot of investors that things are going to look really bad in the near term, especially investors sort of think that the Fed as a government, they have information that they have been withholding that the general public do not have. So this signaled to that, and also at the same time, interest rate that we are seeing right now has declined to levels that we have seen after the great financial crisis in 2008, which is one of the biggest economic crises that we have seen in the last 10 to 20 years. So this sort of indication that a recession is actually kind of a high possibility now. I mean, just back in a few months ago, recession is kind of, there's a possible chance of recession, but it's not very likely. But that thesis has sort of overturned itself. Right now, not only is it possible, the probability of it occurring is actually pretty high already. I think not just the Fed, not just the US Fed, but all across global central banks, ECB, BOJ, they all have actually followed on with their rate cuts as well. And what we recognize right now is that there will be significant impact to the global economy. Actually, some economies even more severe than others, bringing the rate or the probability of recession to be actually pretty high in the next 12 months. In fact, if you look at it based on Bloomberg Economics, their probability actually spiked up quite a bit. Right now, they are forecasting probably around 50%. And I think moving forward, right now, the market is pricing about 70% to 80% a recession in the next 12 months. But compared to 2019, when we've seen the US-China trade war, right now we are facing something that is even more uncontrollable because firstly, we are going to see a demand shock in terms of a permanent reduction in discretionary spending, like tourism, travel, F&B, retail. But yet at the same time, we are also confounded with another fact that there will be a supply shock as well because of the disruption in global supply chain. We are not going to see the flow of goods being as smooth as it can be because if certain countries actually impose travel restrictions as well as city lockdown, workers can, like for example China, workers cannot go back to their workplace, and that will impact on work productivity. So right now, what we are based on the current situation, we project that much of the impact will come quite sharply in the first half of this year. The numbers are going to look pretty ugly in the first quarter as well as the second quarter. In fact, if the first quarter and second quarter were to be contract, by definition, it will be a technical recession already, because a technical recession is defined as a 2 consecutive quarter-on-quarter contraction. But we are actually more optimistic on the other hand, is that we think that the economic growth can actually start picking up across the second half of this year. And we'll bottom around the Q, followed by a rebound in the fourth quarter this year. And it's to do pretty much with the fact that entering this year, things were actually started off. We are actually starting off with quite a positive note before the whole coronavirus situation came about. Firstly, I mean, you are seeing cases whereby the global semiconductor industry has actually started to rebound. In fact, the 5G infrastructure network, the CAPEX cycle, has started to recover very strongly. In fact, a lot of the global manufacturing, which has sort of slumped across 2019, has taken a better turn at the start of 2020. So we are seeing a mere delay of that kind of a cyclical recovery down by maybe half a year. So, and we are starting to, and that trend of manufacturing recovery is will start to take hold in the background by third Q. And also, I think one thing to note is that we think that this negative impact that is going to come pretty sharp is going to be quite temporary. I mean, the global travel and retail industry will be hit the hardest, and consumer spending will likely see a large decline in terms of discretionary spending. Consumer staples should not see that much of a decline, but discretionary, yes, because of the travel and retail. But we think that right now the market has more or less largely priced in the reality of a global recession, given the drastic fall in asset prices. On a positive note, we think that this impact will probably be half, like I said, 3 to 6 months based on historic. I mean, if you look at all other kind of epidemic that have came about for the past 20 years, like SARS, avian flu, swine flu, MERS, the humankind as a whole actually seen on a historical basis a lot of this type of outbreak before. And a majority of them, I mean, even the longest, took about 6 months before the market started to recover. And the subsequent, I think one thing that was quite common between all of them, the last 4 other epidemic, is that the subsequent rebound in retail sales, because a lot of people are just withholding their consumption, but this pent-up consumption can actually be realized in quite a short period of time. And the subsequent rebound in terms of retail sales can be quite sharp and quick as a fear factor fade off and a consumer face some form of frugal fatigue. Yeah. And I think one of the things that kind of shocked the market this week has to do pretty much with the oil price shock, which what was meant to be something positive. In fact, a lot of traders, in fact, a lot of investors have been watching this as a case for people to look optimistic on the oil outlook, because the OPEC Plus could possibly cut production in order to keep the supply-demand dynamics there. But what happened was that the negotiation broke down. Saudi and Russia actually did not come to a consensus whether they can on the amount of output cuts, and what devolved into what it became an ugly price war. And as a result, oil price actually fell quite sharply. The WTI crude free fall to $30 per barrel, close to half of its trading price in just NGen. I think NGen was trading around 60 plus per barrel. Right now it's 30 plus. In fact, last night it actually dropped below 30, trading at 20 plus per barrel. And more notably, I think more significantly, what this entails is that this low oil price will actually affect the oil-producing emerging country, especially in Middle East, in Africa. In fact, our neighbors like Malaysia and Indonesia can be impacted because of that as well. And also on the US side, I mean, back in 2016, that was when they actually became, they moved from the biggest oil consumer to a net oil exporter. And that is actually through the US shale oil revolution. But the thing is that the shale oil operation isn't actually a very it's actually quite a cost-intensive one. So their break-even price for oil is actually pretty high. There was some estimates put it at around $40 to $50 per barrel. So right now with oil at 30 per barrel, majority of them will be unprofitable, and they'll be facing quite a bit of uncertain credit outlook as they face credit cash flow problem ahead. And I think one thing to note that the volatility can remain pretty much heightened is that the fact that the economic calendar ahead is actually kind of busy. I mean, the FOMC, they are supposed to have a meeting today and tomorrow. But of course, more or less, they have kind of made their decision even before the planned meeting. But not only that, but across the entire world, a lot of central banks are actually coming together to discuss what they can do on the policy end to support the economy in times of crisis. And I think on the top of the mind for majority of right now, people are just factoring in or pricing in the fact that a recession is coming. But majority is just purely guesswork. It's not being supported by actual economic data. So when more and more economic data releases to come about, this will actually sort of provide some kind of evidence that this COVID virus, what's the extent in which it's actually weighing down on our global economic outlook as well as earnings growth. Is it worse than expected, or it could be actually people could have the fears of the COVID pulling down on global growth is actually overblown. So with market and what we are seeing, the heightened volatility, especially huge swings of plus and minus 10 in the US, 10% in the US market, has to show that market is pretty much divided in terms of their prediction. So this upcoming schedule of data releases will actually be scrutinized closely by the professional investors as well as analysts, and we'll probably see a lot of more analysis moving forward. We ourselves will be part of those who will be closely watching this economic data as well. So how has the market reacted? The market actually fell into a bear market that we haven't seen since the 2008 financial crisis. All three US indices fell more than 20%, but what really is actually more or less risk off. So all the risky assets, like especially equities are kind of risky asset, they all fell quite a bit. But global equities as tracked by MSCI AC World came down by 29% from 21st Jan was when WHO declared it as an emergency. And based on yesterday's price, global equities have actually fell by about 30%. The US equities, which is S&P 500, has dropped about 28%. EM equities as well. But I think surprisingly, the China domestic market actually held really well. I mean, they were the first to fall, but since then, the government has actually stepped in to provide a lot of liquidity and to sort of provide confidence to the investors. So on the China end, the decline is actually much smaller. But on the fixed income side, what we are seeing is that there's sort of a credit divergence. The safer end, like the US Treasury, a lot of people are starting to snap it up quickly because they were expecting the US Fed to cut rate. But on the other hand, the high yield market, especially the US high yield and global high yield, where some of them is actually exposed to the oil industry, they fell quite sharply because people were fearing that a lot of these oil producers will face increased probability of default as well as a tightened liquidity that will cause some of them to go bankrupt. And a lot of investors actually sold off bonds related to these energy players. So yeah, that's why I say, in fact, if you look at the US Treasury, all three 2 years, 10 years, and 30 years actually briefly dropped below 1%. I think last Monday, it was kind of an extreme risk-off event, and and also the disruption from the global coronavirus outbreak will have kind of a negative impact on the credit ratings for EMs as well as high yield corporate issuers. I think specifically low oil prices has negative impacts on a lot of the oil exporting EMs because they rely heavily on their oil sectors for tax revenue, and because of that, this will actually limit the kind of policy space when it comes to when the government can tap on for stimulus. In fact, a lot of them are running on twin deficit. They're not only their current account is in deficit, their fiscal account is actually kind of in deficit as well. So with prices, and they were depending on the oil sectors to provide them revenue to balance their budget. But with that option being unavailable right now, we actually see that a lot of governments will be scrambling to try to find financing options to balance their budget. And as you can see, the credit spread actually suddenly skyrocketed across majority of the high yield issuers. In fact, I think right now credit spreads are near its 5 years high already. But I think one thing to note is that why we should not panic at current juncture. We think that even if the situation were to worsen, not just the Chinese policymakers, but majority of the entire world, they have actually shown kind of a supportive their supportive stance towards supporting the economy in the near term. That can actually spur growth back to kind of targeted range. Especially, I think what we are seeing specifically is within China itself. The impact on the economy has they took about, I think they started, the first outbreak started in somewhere end December. So now it's March. It took them about a quarter, 3 months to have the whole situation under control. In fact, right now, you can see based on the coal consumption, and also their labor migration, as well as workers going back to their workplace. Usually after the Chinese New Year, it takes about 1 to 2 weeks. Right, this year it's taking a little bit longer, but as the coronavirus situation got contained within China sufficiently, having spoken to some of our China analysts, they are estimating around 70 to 80% of the workforce is actually back in their workplace already. And I think one thing to note also is that the positive effect of last year monetary policy easing by the US Fed, the 75 basis points, will actually start to kick in across the first half of will start to kick in. So we will probably see an earnings contraction, but the contraction may be supported with the fact that financing is actually cheaper at the moment. And the pullback in equity market, especially not just China, but the S&P 500, as well as global equities, actually push valuation back down towards fair or even below fair for majority of the markets. And over the next few slides, I'm going to talk more about it in terms of equities later. In terms of asset allocation, with the fact that fixed income, especially the safer side, has fell quite a bit. In fact, if you see, if you take the earnings yield, the excess earnings yield of equities compared it to fixed income yields, it's actually is up about more than 2 standard deviation away. And as a result, this shows to us as a signal that equities are a lot more attractive than fixed income at this point, at this juncture already. And if you see, credit spreads actually have widened quite significantly within the fixed income space, with credit of high yield surging quite tremendously, and it's now higher than long-term average. However, we actually, within the high yield space, we are quite cautious on the US high yields, which is because of their exposure to the US oil producer, which is the bulk of it, as well as the EM high yield. But on the other hand, I think there is certain bright spots within the Asian high yield, because yields have actually reached its 5 years high. Right now, you are being compensated with about 8.8% yield to worst for Asian high yield bonds. I think specifically one of the concerns that caused a sell down in the property developer, the Chinese property developer, was that a lot of sales and construction was suspended following the COVID virus, which we have, as I have been saying, is that has started to stabilize. And also another thing is to do with the fact that a large percentage of their debt is actually starting to mature in the second half of this year. But we actually see positive ahead for this space is because there is actually lower mortgage rates from the rate cuts within China itself. It will stimulate housing demand. And we also saying that the government has been providing a lot of regulatory support to this particular sector via deferred tax payment, preferential loan terms. And also one thing to note is that within the Asian high yield space, one of the structural headwinds to this particular sector has been that the government was, what was previously thought that the government will actually step in to bail any of these SOC, for example, SOE out whenever they face a liquidity situation. The government did not step in to help last year because they think that this is a moral hazard. This actually, rewards bad financing, bad fiscal prudence for a lot of these companies. But since then, and that was the thing that was dragging down the market last year. But right now, we are seeing that such situation is actually put on hold because policymakers has actually promised that they will provide abundant liquidity and spending to help support its corporate debt market. And as a result, what we are seeing is that credit spreads have widened quite significantly within the high yield space. But that's just a fixed income. For the equities and the sell-off actually caused previously a lot of the markets which were overvalued, say for example US, Europe, especially the developed market, actually came down below their fair PE and also their long-term averages. Say for example, US market that has not been anywhere close to our fair PE for the past 2 to 3 years have actually fell below our fair PE. Right now it's trading around 14 times this year's estimated earnings, which is below our 17 times PE. In fact, across global equities itself, earnings valuations are really, really cheap. So in the near term, yes, we expect heightened volatility. Markets can still come down a little bit more. We think that majority of negative are already priced in. So this is actually quite a good time for investors who are looking to build up, to start investing, to actually start loading in bit by bit. But maybe you don't have to put in everything all at one go, but maybe you can start to slowly accumulate shares on the cheap. We think that investors should not panic and succumb to impulsive trading, but rather focus on the fundamentals of the respective equity markets with actually their earnings growth, their valuations. In this case, valuations for much of the markets are actually quite cheap already. In fact, any pullback in the equity markets actually presents a buying opportunity. So as you start loading in right now, and markets were to come down a little bit more, you can actually even considering doing something like a dollar cost averaging to lower the cost of your investment in total. But as we have seen back in 2013, once the outbreak is sufficiently contained within the globe, investors will actually start to regain confidence in the market. So if we go further down into equities based on sector, we think that the two industries that will face negative impact will be the travel and tourism industry because of travel restrictions, city lockdowns, and aside from the restriction, majority of the people actually voluntarily cancel their travel plans to reduce the risk of contracting the virus. I mean, as a result, I think you don't have to be an analyst to tell that global travel is going to fall quite substantially this year. So the revenue for earnings for this sector for the upcoming quarters are likely to be really disappointing. For the oil and gas sector, because they're not only faced with a double whammy, not just the COVID virus demand decline in the world, but also the oil price shock. So majority of the oil and gas industry players, especially those in the upstream and exploration, is going to face an earnings contraction. credit conditions have kind of deteriorated, so it's raising the risk of default and possible loss of capital. Smaller players, especially in the oil and gas industry with poor balance sheet, may, although with the global interest rate coming down because of the global rate cuts, these players may not be able to benefit from it because banks will actually limit their, they'll see a higher financing cost because banks will try to limit their risk exposure, and they'll face problem trying to to refinance their loans. And not just the two industries, even aviation, retail, F&B, hospitality, and trades are going to be some of the industries that are going to face the brunt of this impact. I think using Singapore as kind of a bellwether, given our nature as an open economy, we are starting to see quite a bit of declines in this particular sector, in those sectors that I've mentioned. But on the flip side, I think that this, at the current juncture, with prices all being coming down, there are actually sectors that are right now that have actually quite a bit of positive ahead for them, but prices got beaten down because the whole entire market went through a sell down. So that firstly, of course, will be the healthcare sector. I think firstly, consumers are likely to take on more protective measures, like to sort of enhance their immunity and survivability, although none of the current drug offering is able to counteract the coronavirus. But that is not going to stop consumers from overreacting and buying, like, say, for example, vitamins and whatsoever to help boost their immunity. So this will actually translate to kind of a surge in drug sales for a lot of the major diversified drug makers. And also the healthcare sector should continue to benefit from a near-term boost in share price as investors support this sector ahead. And not just this, I think one of the, as the normal traditional brick and mortar stores face declines in terms of retail sales, I think the internet players, the e-commerce players are out there to benefit because consumers are starting to shift their daily purchases online, sort of to minimize exposure to crowds in retail malls and grocery market. And as more and more people lock themselves down within at home, they'll be spending more time on their phones. They'll be spending more time looking at videos. So we actually expect kind of an increase in usage time for video streaming, online gaming companies as they benefit, as people look to pass time at home. So this, as more and more people subscribe to this digital entertainment option, companies like Netflix, Facebook, Tencent, etc., they actually see they will be able to benefit from an increase in user traffic, which also means that increase in ad viewership. You'll be able to earn more from advertising revenue, as well as in-app purchases or even new member subscription. So all in all, we identified a few markets and sectors, and these are the funds that investors can actually take advantage of to start to load in. So for example, the China A equities market, the active fund they can go into is Aberdeen Standard China A share fund. But say for example, someone who wants to don't want to go for a UP but wants an ETF, these are some of the recommendations that we have been calling as a house for the last few weeks. And yeah. So in fact, I think one particular ETF that strikes up very well and has been performing relatively quite well against the entire equity market has to do with the China internet sector, which you can actually take exposure to via ETF in Invesco China ETF. In fact, that particular ETF actually did quite well last year as well. And it hosts companies like Tencent, Alibaba, which is likely to benefit in the near term because of the coronavirus. And over the longer term, this company also actually have quite a bit of a sustainable competitive advantage for them to continuously growing within the China economy. Right. With that, I've come to the end of my presentation. I think over the next, as this coronavirus situation would continuously develop, and will continue to monitor it. And over the maybe next few weeks or even a few months later, we'll provide subsequent updates, not just via maybe something like a webcast, but also our articles. So across the regional team, not just the macro team, but the stocks, the bonds teams will probably share a bit more light on how people can position themselves or the kind of products that you can accumulate into at this point, at this juncture of time.